Hi everyone, it's Lee and welcome to the Tesla Economist. Curiosity got the best of me. I just wanted to get a rough idea of how much profit we might be looking at for Q3. A lot of people are saying and telling me Q3 is what's going to take to make the stock price move again, of which they may be right. I wouldn't necessarily say a jump in the stock price, but perhaps put us in the mid 300s, aka over $1,000 pre-split price, which, let's face it, is where we like to be. It's a lot more comfortable price point, I think we can all agree. Now, we still have a bit left to go for the quarter, so this is not going to be an accurate estimate. This is more for indicative purposes, to help us get a rough idea of where Tesla is. I have a suspicion that Q2 results have somewhat messed with people's valuations for Tesla, so this is merely to build some perspective on where we actually are. Therefore, let's not quibble over 10,000 or so deliveries here and there. Troy Tesla's estimate for deliveries for Q3. Troy is very good at these, but if anything, I would have to say he does tend to err more on the conservative side. So the real results might hopefully be a little bit better. He does, however, contribute a lot though, either way. Like I say, we should get an indication. We will, of course, do another estimate closer to the results when we actually have the official delivery figures. I've placed his numbers into my spreadsheet, and as you can see, it comes in at 368,000 deliveries for the quarter. Now, that is a 45% increase from Q2. A 45% increase quarter over quarter. Does that sound big to you? Do you think that might possibly have some impact on how investors may view the company? Now, finally, we get to see a quarter with some of those price increases seriously kicking in, with still more to come, leaving us with an ASP of $55,000, which equates to $20 billion in revenue. Let's add in FSD, which is still going to be at the old price of when these people did order their vehicles, and we get a further $500 million in revenue there. Now onto Tesla's amazing margins. Fremont might look a little high, but when you're doing these estimates, sometimes it requires a bit of bravery to put down these numbers that are so high they look unbelievable. But what do you expect when Tesla keep raising their prices by such large amounts? A lot of it eventually has to end up in profit too. If Fremont margins are this high already, with their old processes in California, with cells made by a third party in Nevada, then what will the future margins be of Texas and Berlin, where the cathodes and cells are made on site? It matters, as Biden likes to say. I have China's margins lower than Fremont's due to not receiving similar price rises. However, they are still getting up there due to the fact they have increased production by so much. In the past, we've done economic models to demonstrate how much the cost dwindles as production ramps. The marginal utility cost decreases each time due to economies of scale, and Tesla have raised their prices somewhat too. On top of that, they're now receiving sales from CATL's latest factory that is in close proximity. CATL have likely a lower production cost with their latest processes, and logistics cost of transporting batteries almost across the road is certainly less too. Also, in some European nations like Latvia, you can buy a Model Y for 42,000 euros. That's slightly under 42,000 US dollars. Even at 30% margin, we're talking under $30,000 cost. And then you have to factor in shipping on top of that. Just how low a cost is Tesla making these Model Ys in China? Then the new factories, I'm going to place just low 20% margins in there. They're making positive gross profits now. It could be higher, but even if it was, these are not going to have much impact with low production numbers anyway. The good news is that they are no longer massive cash furnaces. Anyway, after we factor all that in, we have $7 billion gross profit. All right, that's a decent amount. In fact, nearly double Q2, that was only $3.7 billion, excluding regulatory credits. So let's add $300 million in there for regulatory credits, giving us a total overall gross margin of 35.9%. Seems quite high, but bear in mind we were at 33% in Q1, and prices have increased across the board since then, and some costs have reduced. I would say if you wanted to wind it down, then I wouldn't expect to take it down much lower than 35%, which shouldn't have too much impact anyway. This takes us to $7.4 billion total auto sales gross profit. The other areas of the business is anyone's guess, but as always, they have no effect on the earnings, as they pretty much just break even each quarter, and the auto business is towering over these numbers by now. So I'm just going to copy the same as last quarter, giving us a total gross profit of $7.5 billion. OPEX will be about the same as well. I don't see any reason for that to have risen, possibly slightly lower, and there shouldn't have been any restructuring costs unless all those line upgrades in China might have added a bit, but possibly. I doubt Tesla sold any more Bitcoin either. I don't think they're the sell low type. Perhaps they rebought on the dip even. Wow, that leaves us with income before tax of very nearly $6 billion. I've increased the tax rate a bit from Q2, and this leaves us with a net income of $5.2 billion compared to $2.3 billion on Q2, or a 128% increase in earnings quarter over quarter, more than double. Now, one might think that even Wall Street might notice a jump like that and start to realize just how clueless they are about this company. Q2 was hit badly and overreacted, but we haven't seen the relative improvements from the company yet, at least not in anything tangible that most investors need, like earnings. Anyway, the all-important arbitrary EPS that everyone cares about, leaving us with a non-GAAP EPS of $1.76, which is actually only a fraction lower than Q2 at $2.27, except we've had a split since then. This would be $5.28 pre-split EPS to give you a comparison. As you can see, I've added all the EPS figures for post-split and pre-split, so everyone should get an idea of what contrast this is in earnings. Let's just gain some perspective here now. We have $5.1 billion in earnings, or $20 billion if we annualized that. At the time of this recording, Tesla's market cap is $846 billion. Now, $20 billion goes into 846 41 times, implying that would be relative to a PE ratio of just 41. Now, I would think that this might give the stock price a bump, but this market is behaving very strange. Just out of interest, I also wound down the margin to 34% to see what it looked like, and we still get $4.8 billion in GAAP earnings, which is still over twice Q2. I really don't think margin will be lower than that. So either way, we should be seeing double earnings quarter over quarter. On the other hand, in this model, we are using what I feel are some very conservative delivery numbers. I haven't done my own personal estimates, but I would feel deliveries are likely somewhere closer between 380 and 400,000, yet we're only using 368,000. So out of interest, I also increased them to 388,000, then it adds another 400 million onto earnings, or around 8% increase across the board, which would obviously be even better. Given all that, I would say that I think this is quite likely a good estimate. The margins are possibly a little bit on the bullish side, but balanced out by deliveries perhaps on the bearish side. And even if my margins are too low, we know that the results are still good too. This was always going to be the case. We know Q2 got hit really badly, and we knew that Q3 Shanghai was going to see some serious ramping. Oh right, yeah. This also includes all the downtime Shanghai had whilst they were upgrading the lines, along with energy shortages too. If we could have a smooth sailing Q4, then I think we have a real shot at breaking this 500,000 deliveries in a quarter milestone, an annual run rate of 2 million at the end of the year. That the previous year didn't even crack 1 million total. That sounds like good growth to me. I think we should do some earnings estimates on what 500,000 deliveries might look like for Q4 too. I have an inkling it might shock a lot of investors, or non-investors more likely. So let me know if you'd like to see what they look like. If the Q3 results don't move the stock, then a Q4 like that must. And if not, then the market is seriously broken. And we haven't even seen the real growth start yet. As I always say, just wait for those 46As to get cranking. We haven't seen anything yet. As always, this spreadsheet is available for download on Patreon. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.